Good time to bring in Rakshit Ranjan, portfolio manager at Marcellus Investment Managers, to discuss the outlook going ahead. Rakshit, good to have you on the show and good to talk to you after a gap. So we have been in an interesting market, right? So much news flow in the last 3 months and a fair amount of price correction as well. You tell us, how do you look at the broad framework right now? Because we're getting into the litmus test period, right? It's corporate earnings season. And that's where we have been seeing a series of downgrades even in the last few quarters. So what's the thought process with which you're approaching the portfolios now?
Yeah, good morning, and thanks for having me on your show. I think the corporate earnings season this time round is very different from the last 3 to 4 quarters. Broadly speaking, there are 3 sources of noise which existed in the last 3-4 quarters, which seem to be now fading away. The first source was with COVID-related lockdowns or COVID-related business coming to certain companies. There was a lot of sort of noise in the comparables. Either companies were shut because of lockdowns, and hence the comparables weren't normal; they were aberrations, or they were getting some COVID-related business, which obviously was not sustainable. The second type of noise was after the Russia-Ukraine war, commodity producers, they saw a massive benefit in the reported fundamentals, and the commodity consumers, they saw an adverse impact on margins, right? And that as well is a factor which I think from particularly 1Q FY24, partly from 4Q FY23, that factor will also start showing signs of fading away, certainly in the commentary of the management teams. And the third bit was FY22 in particular was a year where many companies, they latched on to the opportunity to accelerate their capex, their investments in various areas in order to benefit from the crisis, from the COVID crisis. And those capex investments, whether it be around tech, around a new acquisition, or adding new revenue growth drivers to your business, those kinds of investments have started to yield results or will start to yield results, and positive or negative outcomes on those will define the corporate earnings. So it'll be a lot more comparable, particularly from 1Q FY24 onwards, and commentary especially from 4Q FY23, which should sort of start separating the men from the boys in a much better way than it had in the last 3 to 4 quarters, the way we see it.
Rakshit, morning. Reema here, particularly on Bajaj Finance, and this has been a favorite of Marcellus Investment Managers for a while now. I know in the past when the stock had dipped considerably during COVID, you all had gone ahead and lapped it up as well. Well, there is a possibility of a big disruption in the space with Jio Financial Services planning, to go for an IPO. Do you see the business model getting hurt for Bajaj Finance?
Right. So to begin with, there are 2 or 3 data points which are actually very attractive for an investor when you look at Bajaj Finance. One is that this is a company which is not 30, 40, 50% of the market share in the lending space. This is only 2-3% market share. So there are far more weaker competitors to gain share from rather than worry about any new entrant. And new entrants have kept coming here. Certainly, the new entrant you're talking about, they will have a massive benefit on the capital availability side, liability side, given their parentage, etc. But I don't think that means that a 2%, 3% market share controller in the lending space is the target only. Secondly, I think Bajaj Finance as a business has transformed quite meaningfully and quite positively the way we see it. If you look at the fee income contribution to their profits, it's significant. So a simple statistic there. 2/3 of Bajaj Finance's loan disbursement in a year comes from existing cross-sell, upsell customers, right? Existing customer base. That existing customer base has had only a 3% AUM CAGR per customer over the last 5-6 years, but a 14%, 14% profit after tax CAGR, right? So it's a fintech company being transitioned away from just being a lender. And hence, there are many strengths getting added to the business, which keeps us excited. And typically, higher the quality of the company, it manages competitive intensity in a much better way. This is not that Bajaj Finance had a good run in the last 10 years because of weak competition. That's not the case here. We look forward to how they respond to competition. But at the point in time, at this point, we are quite convinced. And as you rightly said, it's part of many of our portfolios.
Okay, Rakshit, good morning. We were just talking about how the markets have corrected significantly in the past few months. Have you identified any new ideas in this time where valuations perhaps after this correction now look more reasonable and you would look to add? Is there any kind of new idea that you've identified?
Yeah, no, in our smaller cap portfolios, there are a few ideas that are getting added. Some of our existing portfolio companies, so for instance, Divi's Lab is a company in our large cap portfolio, CCP. The crash in the share price and the attractiveness as a result, incremental attractiveness compared to where it was a year ago, has meant that we've actually added Divi's in one of our other portfolios as well now. So there are new ideas which we are working on, but more importantly, a lot of the work on existing ideas has become far more attractive given the valuations. You're right, and hence we are rebalancing and changing our portfolio constructs there.
Rakshit, speaking of the portfolio construct, you still do have Dr. Lal PathLabs in one of the funds, right? Yeah.
Yes, in many funds, yes.
In many of your funds. So let me ask you this. Everybody is getting the flu, but the thing is that not too many people are testing. We had Ameera Shah of Metropolis actually on the channel a couple of days back, who also kind of was pointing in the same direction, that there is a lot of competition and price cutting in the B2B segment. On the other hand, at the retail level, even with the flu cases going up or some COVID cases, RT-PCR testing is not exactly picking up. So what's the thesis here, given the huge price correction we have seen in these diagnostic stocks?
Yeah, the thesis is not about seasonality pieces or sort of short-term oriented pieces, because for a business like this, there'll always be a year where dengue outbreak was far greater than the previous 3-5 years. There'll be a year where swine flu and bird flu and COVID, and there'll be many other, and there'll be a healthy year in terms of health of the customers, and hence low footfalls for certain types of tests, so on and so forth. Those are fluctuations which this business will always have. Every year will be different from the last year around certain disease. But that's not the thesis basis which we buy companies. Our thesis here is that the space is huge. It's a diagnostic industries 90,000 to 1 lakh crore in size. Within that, pathology is at least half of it. Out of that half of the pathology industry, mom and pop labs and government labs together, they control more than 80-85% of the rest. And hence, there's barely 10,000 odd crores, which is in the control of pan-India chains. Now, pan-India chains, they offer massive value add compared to the mom and pop labs or some of the government operated labs. And that is where, to begin with, there's a massive market share shift opportunity which is being capitalized on from non-pan-India chains towards pan-India chains. Amongst the pan-India chains, then, we see not too many companies strengthening their long-term oriented competitive advantages. For instance, for somebody like a Dr. Lal PathLabs, we see this firm being very differently positioned today versus 3 or 4 years ago around the way they use technology to do not just D2C, which they had left completely open, and hence many of the private equity funded players actually entered, but also B2B for somebody like a Dr. Lal is happening via a lot more tech-oriented solutions provided to hospitals, which helps the hospital do their job better, etc. So this is no more just a sort of cutthroat competition on pricing, related B2B industry, and the strengths are far more around hub and spoke management of the retail execution that we see for a business like Dr. Lal.
Rakshit, thank you very much for joining in. So it's a play on the formalization of the diagnostic space and an increase in market share of these larger pan-India companies. Thank you very much for joining in. Get into a break. We'll come back with more on the markets.